Welcome to this webinar. This is to set expectations about post-contract negotiation operational PPAs. We're going to explain what's happening. This is not about modeling deals or renegotiating them. This is really about explaining what's happening. We know that intermittent resources have variability. And there are a lot of different data coming from your contracts, your PPAs. So this is about figuring out, what's most important, how we're diving into how to explain this variance to different members across your team, whether it's sustainability, finance, leadership, whomever. So if you're not in the right spot, uh, now's your time to leave. But we welcome you all to stay. Um, I see some familiar faces online. So, for those of you who don't know me, Sam Cotterill, I'm Director of Client Enablement and Engagement at Verse. So, what I do is sit between our prospects, clients, the data science, engineering, marketing, and commercial teams and try to bring everything together. I come from a background of sustainability consulting, or as a manager on a carbon advisory and renewable energy team. Before that was 7 years in the energy transition research space. Really excited to bring a new face to the Verse webinar series. Miss Amberlyn, I will let you introduce yourself and welcome to the Verse podcast universe.
Thank you, Sam. I'm so excited to be joining for my first Verse webinar today. So just a quick background on myself. I'm a business operations manager here at Verse, so been here for around 8 months now. At Verse, what I do is in some ways similar to Sam, working with a lot of our customers in delivering the full scope of their work and working with our engineering and data science teams. Usually my teams are more behind doing some of the analytics and customer services layer on top of our software to make sure that all of our customers are really utilizing the software as best as possible and also getting any specific insights and analysis they want for their assets too. Before Verse, I was at Bain and Company, and I worked in the utilities group doing a lot of financial and asset procurement modeling for large investor-owned utilities in the electric utility space. I also did do a couple stints and rounds with various Fortune 500 companies on executive strategy, leadership reporting, so very familiar with various types of reporting that goes on in large corporates.
Well, welcome to the webinar. I feel like I almost said podcast there because that's the world we live in these days. Couple of housekeeping items because this is a webinar, not a podcast. This can be interactive. So if you have any clarifying questions, drop them in the chat. What's on that axis? I don't know what you mean by X. Those we're going to take live and answer them on the spot. If you have more, theoretical, systemic, high-level questions, we're going to table that to the end. We do have time earmarked for Q&A and hope to get to as many questions as we can. A little bit more about what we're going to get into today. I'm going to introduce you to Verse. I see new names on the line. For those of you who are regulars, first of all, thank you. Second of all, bear with us. We're going to get to the good stuff after that. We're going to talk about a big problem here, which is clarity through the data. Yeah, we know that these assets are data generating machines. Well, they're technically power generating machines, but they're also creating a lot of data in the wake of power. And we're really going to focus on how to bring clarity, not just to the teams that live and breathe this, but those that are tangential to your energy program. So we've laid out a 4-pillar framework that is really focused on explaining PPA performance. So we're going to take a deep dive into that. We hope that what you get from this webinar is an ability to explain any variance clearly and really have a framework for setting up an internal system to do so. And then, of course, we'll get to Q&A. So who are we? First of all, we are software first. We are built by energy buyers for energy buyers. Verse is unifying energy data, helping plan, forecast, and operate these assets. So you can run your portfolio with confidence. It is an app-based environment, kind of a la carte, choose your own adventure here. Everything from understanding your load to creating a renewable glide path running discounted cash flow models for future investment, investing, going to the market and transacting, managing operational assets, and really understanding how it all comes together through a risk management lens. At the end of the day, just trying to give energy buyers and organizations better tools to make smarter energy decisions. Our team is really a combination of those from the energy world with energy experience. Amber, myself, stuck with us today, but also some really incredible tech backgrounds, really software focused, data focused. So a whole bench of PhD data scientists and statisticians, and coders doing things that I couldn't, in my wildest dreams, imagine doing in languages that I can't even pronounce. So that's cool, but we're going to really focus on the energy expertise today. Um, Jumping in. Yeah, fun tagline. Yeah, marketing made me put this in, but I'm better for it. So, financial grade software, deep power market knowledge, battery deployment expertise, helping energy buyers accelerate grid connection, contain risk, and control cost. I laid this out at the beginning, but look, there's a ton of data coming from these projects. PPA owners are rich in data, but sometimes a little poorer in the explanation of those data. So we're going to really focus on interpretation today. What kind of data are coming out of these projects? Well, we've got generation meter data, of course. We've got pricing. Those are kind of table stakes. But we're also thinking about things like availability, curtailment, we're forward energy price curves, creating forecasts, understanding basis, met data, what's happening with the weather, different settlement mechanics, credit support, environmental attributes and the transferring of them, emission factors, like all of this stuff is swirling around in spreadsheets, unless you're using Verse. And data really isn't the problem. We have that in spades. It's really sorting through it to answer questions because that's ultimately, at the end of the day, what we're trying to do. So, Amber and I work with a lot of our clients, and these PPA owners, again, don't lack data, but a lot of the same questions are coming up. Is that asset performing as we expected? Uh, why are we above or below budget? Is what the developer telling me valid? Is that what's actually happening there? So again, this isn't a theoretical deep dive into policy or a renegotiation of a contract, but this is going to be a session focused on, here are the numbers, here's what's happening, and here's why it's happening, and helping surface, what's happening every month with your asset or portfolio of assets. And let's take a step back and kind of start with the basics. First of all, renewables don't behave normally. And what is normal? Well, normal would be probably, reacting to a price signal saying, oh, prices are high. I should produce power now. Therefore, I'm more profitable. There isn't a dispatch of renewables. This is, it's not reacting to the market. In order to make money with a renewable asset, you really need to have a perfect combination of these three things. I need resource availability. That's weather. When the sun is shining, I'm producing as a solar asset. When the wind is blowing, I'm producing as a wind asset. Duh, right? Like we get that. But the price in the market has to align with that generation for you to make money. This is a fixed for floating arrangement. You have a strike price. If you're generating at power when the market is under the strike price, it's actually costing you money. And let's not even get into negative price environments. So let's think about that. We've got the resource availability, we've got the market price, but then there's also the timing. So you could have we're going to get into this a winter storm for an event where the weather is there, there's a lot of wind, market prices are going crazy, but your wind asset is iced. Your solar asset has snow on the panels, so the timing isn't there. Scheduled maintenance, emergency maintenance, those are things that you can't control that are important from the timing perspective. So when you think about it here, you can have the resource availability and high prices, and the equipment might not be producing, or it could be directed to curtail. You can have the resource availability and the asset is online, but the market prices are low. You can also have a high price market and your assets online, but there's just no wind or sun. So, what we really need is a combination of those things, which is why we say this isn't a normal, market signal based dispatch, I make money arrangement. So let's get into this. We're going to
Oh, one
talk
thing,
about,
Sam,
yeah.
here on this slide too, I think all the dynamics that Sam just described are the exact reason, as many of you are probably aware, of that forecasting is really difficult here. And because renewables don't behave normally, you get even more questions from your leadership, from finance about why are my forecasts not matching the actuals? Do I need to think about ranges? And just once the actuals come in, why did it change versus the forecast? And this is a big reason why we have all of these topics that we're going to discuss today.
So when we're thinking about, yeah, and thank you. When we're thinking about those topics, it's like, okay, did we expect this outcome? That's what Amber was talking about with the forecasting. Like, okay, if so, great. If not, is it an acceptable outcome? And whether or not it's an acceptable outcome, can I explain it? And I think that's where that last piece is where we're really, really going to focus today. How do I explain what's happening, in that Venn diagram where there's a shifting overlap of those three variables. And we're going to actually use a pretty timely example right out of the gate here. The elephant in the room. We just all came through as a whole country, Winter Storm Fern, and we're sitting here on the 12th of February. If you're managing a VPPA, a PPA, you know that there's a lag time between the close of the previous month and when a developer pulls together your invoice. So, big question, the elephant in the room is which, if any, assets in my portfolio were generating during Fern, which created a really volatile but also high price environment. And what I want to do here is actually put this to the test. We're gonna send out a poll, Q Blake, and ask you today or going into this week, do you know whether or not your asset was online? Do you know what the financial result from that last week or so of January was and how it impacted your January settlement? I'm seeing here I can't vote. I guess that's fair because I don't manage my own PPAs. Let's give everyone a second to respond. All right. Should be enough time for people to click a yes or a no. Drum roll, please. All right. Some of you, maybe hopefully these are our clients responding in the affirmative. But some of you still don't know today whether or not your VPPA was generating during the high price environments. Um, yep, that's what we're going to talk about. So Amber, I'm going to turn it over to you to walk through a case study and explain how Verse approaches that very question.
Yeah, thanks, Sam. So we're going to look at an example ERCOT North wind asset and look at it in a couple different scenarios. So first, just to summarize, what is the background here? So starting on the first column with the customer challenges, during Winter Storm Fern, we know that ERCOT plummeted into sub-freezing temperatures and there were price spikes over $1,000 per megawatt hour in the North Hub. So what happened at looking like 70% of the poll responders in this call didn't know their assets performance, and we won't know until maybe next week when the developers typically issue their monthly invoices. So in the meantime, you might have been getting leadership questions wanting to know how did we perform? And oftentimes an initial hypothesis would be seeing these high prices, we think that we're going to be making a lot of money during these high price hours during the storm. But we might not know whether our asset was fully generating that timing component that Sam was talking about during the storm or not. So waiting that month of time is really just not ideal for most of our customers, and they want to know sooner rather than later what actually happened. So with the Verse approach, what we have done for several of our customers is connected this API integration directly to the asset, which means that we can directly get near real time or 1 day lag data of how the asset is performing. Revenue meter, we also have availability, weather data that can help improve modeling. So various types of data, but focusing on the revenue meter data, which informs the generation, that can directly let us know with minimal, near zero latency what the asset was doing. And we don't just get the data. So I think some developers provide that view as well. We also pair it with exactly what your asset has in its contract terms, and we can calculate the settlement based on that. So
Amber,
finally, yeah.
quick question. I may have talked about this on the timing slide, but honestly, I don't remember. Why wouldn't, if there was wind, why wouldn't my wind asset have been generating?
Yeah, great question. So some common phenomena we see during extreme weather events like a winter storm is there's icing and also low temperatures, low enough that the wind turbines need to be shut down in order to maintain the asset health longer term. So we definitely saw events of wind turbines being iced out, meaning they had to shut down. But there were some turbines that did quickly regain and come online after initially being iced out. Yeah, anything else to add there, Sam?
No, no, that's helpful. Thank you. And I think I did mention this one, but if it snowed, there can be snow on panels. But we're talking about wind right now.
Yes, that one's probably a little bit easier to
Yeah,
understand. But
exactly.
there's also instances where the asset manager is responsible for trying to clear off the snow as quickly as possible to get that asset generating.
Yeah.
Great. So final result is that with this telemetry live feed data integration, the asset managers can go directly to their leadership entering February with the clear understanding of the performance rather than sending questions to the developer who they're also really overloaded during the storm times and might be slow to respond. We've seen that happen. So you can directly get your answers with high confidence. So we'll dive a little bit deeper and show you some numbers of an example wind asset. And there's two scenarios here that could have happened. It was either iced, which we just described, and so it was down during key moments of the storm peak pricing. And then scenario B is if it was performing, which means that it's fully able to generate, it was able to capture all the high value intervals, even though many other outages were occurring. And so in these two instances with the Verse API integration, in the first case, we were able to see, okay, there was zero generation through these 2 days of the storm. That allowed the team to adjust hedges and notify leadership immediately. In scenario B, we were able to verify the availability during the storm, directly seeing the generation data coming in. And it was able to capture extreme peaks, in this case, during the evening of Sunday, January 25th. So we'll show some of the numbers on the next page.
And I think, I mean, just kind of underscoring the importance of this, January month to date before the storm was unseasonably warm, not a lot of natural gas hitting the market, low gas prices. So the actual clearing prices were pretty low, and month to date PPA performance was trending towards signing the check on the front and not the back for a lot of energy off takers.
Yeah, that's a great point too. When we focus in on the storm days, these days your asset was likely making money because of the higher prices, but it would balance out with an overall monthly outlook that was in the red for most of our customers. So just taking a look at what the UI would give you. On the left-hand side, on both sides, I'll just walk through the three different charts we're looking at. The top one is generation. So we've built a dummy data set here for a sample 220 megawatt wind asset. So this is just showing the generation profile of how many of the megawatt hours generated per 15-minute interval here, since we're in ERCOT and we're settling in real time. And then in the second chart, we have the 15-minute real-time price at ERCOT Real-Time North Hub. And the bottom, we have the net span calculations that, again, encompass all of your specific contract terms, your price floors, or if you had any allowances for no settlement periods. So here on the left-hand side, we can see that the asset went fully down, just using some clean numbers here during the 25th and the 26th. That means they missed out on this price peak, especially in the evening of January 25th of over $1,000 per megawatt hour. And then in the very bottom chart, you can see this translated to zero earnings. At least it was not in the red during this period, but it was zero when it was missing out. And one flag here is that we are showing the numbers in accounting style. So negative is good for you on this chart and positive is bad for you on this chart. But we have had customers who prefer to see it flipped. So on the right-hand side, now we can see the asset was performing, and it wasn't even performing that well. It was a lower generation than you can see before and after the storm. But even with a lower amount of generation, it was able to capture some of those price peaks, leading to $260,000 of earnings in this 2-day period. And then if we total up the 4 days of the higher price peaks, you can see from the 25th to the 28th. On the left-hand side, we still ended up earning some money, so 320,000 total, but on the right-hand side, now we got to capture 580,000 total with the storm. So these are reflective of, I think, actual magnitudes of a 220 megawatt wind asset.
Yeah, just to be frank here, we saw outsized results that, from some assets that really overshadow what you're seeing here. And we did see assets that did not perform at all during these high price events. So, having the ability to look across many portfolios of assets, it was really interesting to see market to market, technology to technology, even the same technology in the same market, very, very different results. And that's, just kind of underscores the importance of being able to monitor in near real time. So let's get into explaining these deviations. So, I think 70% of you don't know what's coming. Yeah, next week, let's flip a coin. Was I on? Was I off? I saw there was weather in the area, but I don't know if I was impacted. Let's get into this retro. So thinking about performance at the highest level before we dive into explaining it, a lot of our customers are thinking about comparing what happened on two different scales. One is I've had this asset online for over a year. Let's compare this month to this month last year. And even if that's not the case, a lot are thinking about, well, I don't really care that much about what happened last year. It's interesting, but let's also think about what's happening compared to the forecast that I put in front of my finance and leadership. So I think the underlying message here is like no two periods are going to be the same. And there are going to be differences, and we need to really dive into explaining them. So Amber, you want to talk about the different pillars in our four-pillar approach?
Yeah, for sure. So what we really wanted to break down here were all the different drivers that end up leading to your net spend, since it is a combination of a lot of different factors. So the three overall factors we looked at, and then we broke number two down a little bit more, generation weighted price, and the contract terms. So under generation, this is probably the easiest one to understand. It's going to be based on both the resource availability, was there wind, was there sun, and then also operational performance. So did my specific asset, has it been having many years of degradation? It's an older asset. Or it's down because the maintenance didn't go so well. So there's asset-specific operational performance as well as the resource availability. From an outside perspective, we mainly focus on the resources since we can get that data, but we can also pair in through telemetry or through developer notifications, understanding the operational performance as well. And then on the generation weighted price side of things, the main two impacts are the prices and the capture rate. So really reflecting what Sam talked about earlier with the timing. So the capture rates is all about the timing. I won't go into too much detail because he will dive into that next. And then finally on the contract terms, we'll also, again, do a deeper dive, but this is everything that is your specific asset. So what's the price, the settlement structure, Are there any basis risk adjustments, intervals that the developer can select to remove or automatically remove? And also availability guarantees of many different flavors, which again, we'll do a deeper dive into this a little bit later.
So I know for a lot of you, this might be like what's stressful about the world that we live and operate in, but it's also kind of what's fun. So hopefully you enjoy some of these dynamics as we go through them. But before we do, I'm not clicking in the right spot here. We want to ask you one more question. Last one, I promise. So I encourage 100% participation. Um, we want to understand how this audience is actively monitoring their PPA. And by that, what I mean is it's kind of retroactive performance. So you get an invoice every month from your developer. If you're on the left side of this, you pay that invoice. If you're moving towards the right, you pay the invoice, but after you look at the rows and columns and match the different costs with the different generation and essentially do a data exercise. Um, the next one over is really going to focus on cross-referencing all of your contract terms. Were the proper basis differential intervals selected? Was there economic curtailment? Was it permissible? Did we count in the price floors in our settlement? So the kind of the next level of invoice validation. And then the third one here is I think, creme de la creme. I am modeling exactly based on real world conditions how I think this asset should have performed, and I'm comparing that to what I'm being invoiced against. So let's throw up that thank you, throw up that poll, and would love to see how you all are reacting to monthly settlement information. I'm gonna switch to my water. Think I've inadvertently been taking sips of coffee between every slide, and that's probably not a best practice. All right.
Keep the energy up.
Looks like some pretty good participation here. And closing the poll, please. Let's see what we got. All right. Wow. Okay. So varied results. I think that is actually indicative of what we see as well. So, if yeah, this is interesting. So I think the goal of this webinar is let's move those of you in from A and B up the spectrum here, and let's start thinking about how we can get into C and D. So let's talk about the first pillar. Love this tagline. Was it an act of nature or an act of operator? So let's think. Okay, our production was down. We are seeing that we're below budget this month from a generation perspective. There's a gap in our expectations. So let's think about the first thing here and contextualize performance. Was there resource availability? How do I compare the wind? So there are a couple of ways that we're thinking about this, or the sun, sorry, solar, not trying to put solar on the bench here. So solar radiation, wind speeds, these are data that are available. We can use triangulation of weather stations to get within a square mile radius of your asset and understand what actually happened. And that's, if telemetry isn't in place where, we get the met data directly from on-site weather stations. So I think contextualizing against what happened last year, if that's the metric you're going for, or against a 10-year average or 30-year average are the two best practices here, depending on whether you're using a P50 or different expectations. So what I think that what we're really showing here is the fuel input of a renewable energy generator is important for whether it can generate. And when we're communicating that with our leadership, there are ways to do it that are, I'm not thinking about watts per meter squared or wind at different hub heights in meters per second. Sometimes that's a little too in the weeds. But we can also visualize those data so that you can see, okay, across my portfolio, I know where my assets are. and just show me this month, how did solar irradiation or wind speed deviate from long-term averages? Was the resource actually weaker? Is that why we didn't produce as many megawatt hours as we expected? How did that compare to my peers? We in some markets we can look at those market data and see what the generation from different assets are. Are they having the same experience that we are?
Yeah, one comment here too is why are we showing 12 months versus a long-term average? So the 12 months ago data point is really helpful for understanding just based on September of 2025 versus September of 2024, since that was the real data point that people saw. Why was there a deviation with that month 12 months ago? But the long-term average is much more indicative of how forecasts work.
Yeah.
So most of the forecasted amounts are going to be based on a long-term average. And that's why we end up just looking at both data points.
Yeah. Yeah. Very helpful context. Thank you. All right, let's think about price now. So we're into pillar two. It's really important to understand, not just that the price was different, but what are the explanatory variables? And of course, the tail of this list is really long. But what are some of the most correlated explanatory variables? And when we're thinking about these markets, it's gas price, like across the United States, hands down, we're thinking about gas price. We're thinking about weather, not weather in the sense of resource availability, but weather in the sense of how is what the temperature or other conditions changing demand on the grid. Econ 101, supply and demand, price. You guys got it. I don't need to explain that to you. And then another thing that is really a phenomenon of the last couple of years is net demand. We went through this period of over 2 decades of flat to negative demand growth in the developed world. That has changed. And if you've attended any of our webinars, you have seen graphic after graphic, heard conversation after conversation on what's happening there. So I'm not going to go into that in great detail, but you all know that cloud, AI, data centers, it's the talk of the town, not to mention industrial electrification, transportation electrification, many things driving net energy demand on the grid. So let's dive into a couple of these a little bit. Uh, Heating and cooling degree days. Again, not resource availability. Really interesting. If you follow us on LinkedIn, you may have seen our co-founder Matt post a really cool, he's Australian for context. Don't hold it against him. Just kidding, Matt. But post a really cool comparison to what was happening in ERCOT during Winter Storm Fern and what was happening in Australia at the same time. Amber, I know you're a big tennis fan, and we're watching the happenings in Australia for the Open, where they were hitting record heat while we were hitting record cold. What you see on this left-hand chart is a U shape, right? So on the vertical axis, we're looking at total demand of electricity. Horizontal axis, we are looking at the temperature range. So across the x-axis there at the bottom, baseline 65 degrees Fahrenheit. Sorry, Aussies, we're working in Fahrenheit. But what you can see is as temperature deviates from that baseline, whether it's getting hotter or colder, it's changing the demand on the grid. And it's those demand changes that have the most impact in short-term pricing in the market. So that's why understanding the impacts of heating or the whether or not we're in a high or low heating and cooling degree day or total degree day environment is important for explaining demand, which in turn explains market price. And then I may have lied to you. We do have a graphic on data centers. Sorry, but this pipeline of data centers, this expectation of what kind of demand is going to hit the grid between now and 2030 and beyond, really is changing markets. So we're keeping a close eye on that. Jumping into the next
Oh,
pillar. Yeah, go ahead, Amber.
one quick
Sorry.
comment here too. The exact drivers of market prices too, if we don't see they align, like maybe the market prices are low, but gas is going up. And there might be questions around what are the other factors happening. Sometimes there's also congestion, hub specific dynamics that you want to check into. And for Europe, there might be an impact of carbon taxes and auctions happening too. So we'll take into account your regional dynamics.
Yeah, great. Um, Timing. We've talked about timing at the top of this section. I'm not going to kill you with it, but I do have some pretty cool charts to show you. I think the big takeaway here is when you generate matters just as much, if not more, than how much you generate. From a financial perspective, megawatt hours is secondary to dollars per megawatt hour. Obviously we're here because we are signing these contracts because we want those megawatt hours. We want to have an impact on the grid. We want the RECs or EACs depending on your market. But that around the clock or average price is only part of the picture. We really need to focus on when we're generating. And not to beat a dead horse here, but I am going to lean into what happened last month because it's relevant and recent. So let's think about capture rates. And obviously, you can compare that to, how your asset did in the same period previous year, long-term averages. But let's look at some real-world examples here. So this is ERCOT. This is wind. We're talking about West Hub, high renewable penetration. So what we saw here on the 23rd of January was a lot of wind. You're looking at that orange line. You can see as the wind is coming online, you are absolutely seeing a decrease in price, that yellow line. This is what we call a cannibalization effect with a high renewable penetration environment. Because these are zero marginal cost resources, when the wind is blowing, we are generating. When we are generating, we're selling. We're even selling into negative price environments because of the production tax credit, right? So it floods the market. It pushes expensive fossil fuels off the merit order, and we'll get into the merit order a little bit on the next slide. But can, as I mentioned, drive prices to even negative. So what's the takeaway here? If you are creating a portfolio, diversification of technologies is certainly an important part. And we're not going to get into today, but even adding utility scale energy storage systems to your wind and solar portfolios can be a way to hedge against what we call here a shape risk. I mentioned I was going to go quickly, so I'll go quickly again, but this is a different picture. This is solar. So instead of wind in that orange line, you're going to see solar. This is a couple days later in ERCOT. We switched from West Hub to North Hub. What we're seeing here is that impact of solar on the dispatch of natural gas. Prices are high, solar is offline, gas is pumping. Solar starts to come online. Look at that correlation, causation between the solar ramping up and the gas ramping down. And let's not forget about the price line here as well. So merit order. So power plants are stacked from lowest marginal cost to highest marginal costs on a supply curve. Market is going to dispatch out to the level of demand, and the cheapest units go first. So the last unit needed to meet the level of demand is setting the cost. That's called the marginal generator, setting the price, excuse me, not the cost. Wind and solar have near zero marginal costs. They're going to dispatch. There's no fuel costs. There's low O&M. There's no reason to withhold the output of these assets. And this merit order effect is why capture rates drift downward over time as renewable penetration increases. All right, we talked about timing. I'm going to turn it over to Amber to talk about contracts.
Yeah. And yeah, just one quick comment on the capture rates too. I think we've already started. This is a great snapshot of a small period of time. But as Sam was saying, over time, you can really see these effects add up. And that's another reason why we get a lot of questions around why is this forecast looking this way? What is the impact of all this increased solar and wind in this area? When can I expect data center demand to come and even that out? So a lot of these discussions carry on in the forecasting. Awesome. Okay, so final pillar here. This is all about your contract terms and developer claims. And some notes here. So I think you're all familiar with really long VPPA contracts. A lot of times we're talking to our customers and they weren't even the ones who negotiated this contract. It's often a different team or someone who it happened so long ago, this person had left the company. So they're starting from scratch a lot of times and understanding this contract. And on the developer side of things too, oftentimes there's very specific and unique terms for this one asset. So the developers are also developing a way to consistently apply the contract terms in their invoice Excels for the first time. So it isn't necessarily something that either side has a lot of familiarity with, which is why we found it helpful to have a third party like Verse come in and validate some of these terms and have another perspective. Um, so the two examples here are, how do I know if these terms are being applied correctly? How do I know if I can trust some of these developer availability reports? So we'll dive into that next. So just a quick overview of some common contract terms. So the three buckets here: settlement mechanics, starting with the easiest ones to validate. These are probably the ones you're very familiar with. So price floors, price ceilings, sometimes applied at the interval level or at the monthly level. There can also be no settlement periods if the price is negative or if the node price is negative. Some contracts have that kind of clause. And also upside shares. So if the floating price is above the fixed price, then you also need to share that upside with the developer. So these types of mechanics are on the easier side to validate. And then we move into some of the more difficult ones. So basis adjustments is the second one, and we'll do a deep dive on how to validate it. But just definition here, a lot of contracts have this term where in order to help protect the seller from extreme differences at their node price versus their hub price, there might be a term that allows the seller to identify any intervals where there is an extreme difference. Usually the difference is defined as when the seller stops making money. So when it's bigger than the difference between the fixed price and the PTC added together. And then they can select a certain number of these intervals to remove from settlement or recalculate using the node price or another agreed upon price instead. Sometimes it goes both ways. So if the node price is much higher than the hub price, there might even be a buyer basis differential interval where you can also benefit from that node price being higher than the hub price.
And
So many
just a
variations again.
just a word there. I said I wasn't going to talk about origination and signing contracts, but here I am. Sorry. Um, we're in a seller's market. You all know that developers are getting more and more of what they want into contracts than the good old days in the 20 teens. I think they learned a lot from those periods where the basis risk was pretty much 100% put on the seller of the energy. That has come back to bite them in you know what in many cases. I'm thinking like SPP wind, for example. So this is a really relevant term in today's PPA negotiations, where more and more of this basis risk is shared between buyer and seller rather than put 100% on the seller. So really relevant.
Great call out. So final one here, availability guarantee. We've seen something like this in pretty much every single contract, and there are a couple different flavors too. So the goal of this really is to keep the seller accountable for producing a certain amount of the time, but also have a little bit of leeway, understanding that there has to be some maintenance, maybe some unexpected outages every single year. So we give them a little bit of leeway. So usually the seller must hit some guarantee percentage, usually around 90%. We've seen as high as 95% usually, or as low as 85%. And it can be based usually on two different ways. The most common one is mechanical. So it's really based on just, is the inverter connected to the grid capable of delivering electricity, the inverter or the turbine? And we've also seen a little bit more recently and becoming more popular, a production or yield-based guarantee. So this is usually creating a benchmark, a physical model of how the asset is expected to perform. And then you can actually compare the actual performance versus this predefined benchmark, which the seller usually does have a lot of say in defining based on usually like their own provided models that they sold you with in the first place. So we'll talk about how to validate both of these types. So first, on the basis adjustment side of things, this is essentially our method of how we go through and validate these basis intervals. So we look at all the hub and node prices, and we can just validate that the correct node prices are being used. Then what we do for accruals, so let's say it's a historical prices. So we actually know exactly what happened. We can calculate what the basis differential intervals were. So this month you expected to see 10, 50 intervals. And then we can also estimate the likelihood that the developer will select these intervals. So usually that's based on looking at the history of the patterns of selection. So usually it's based on a contract year. They're allowed to select a number of intervals per that contract year. So in the beginning of the contract year, they might be a little bit more conservative because they want to de-risk if there's a lot of intervals later in the year. But once you're hitting the final 3 months of your contract year, they're very likely to select all of the intervals. And this, we've seen this make like a tens of thousands of dollars impact on your monthly settlement. So you might be under predicting how much you have to pay because you're not taking into account the basis adjustments. We also apply this into the forecasts. So we can look at this history of the hub and node price differentials and then use that as an additional factor on top of our forecast modeling. Then last part on the availability guarantees. So how do we actually validate whether this report that the developer is sending us every year, is it actually accurate and reflective? So there's a couple different steps that we take. So first, just data and logic, that's the baseline. We make sure that all intervals are accounted for, and these are done in the quantity of turbine hours or inverter per 15 minute. So it's going to be based on the number of turbines or inverters that are at your site, not the overall asset together. Then we look at these three different categories. So in the right-hand side bar, in your annual availability report, you'll see intervals that are available, excused, or unavailable. So within the available ones, that's where we really need another model to check whether these available intervals are valid. So what we do is we compare it to a physical model, which if you have the contract term for it, we can replicate the actual physical model in the contract term, or we can create our best version of a physical model and then look at if the asset was generating similar to the physical model, whether it was fully out, whether it was partially out, and then this can help create a watch list essentially for what are the intervals that we think the asset says it was available, but we think maybe some of the turbines or inverters were actually down. Then you can go back to the developer and have them relook at that area. And then finally, for the excused intervals, this is where the developer has marked some type of excuse, a contract allowed excuse for having this interval not count towards their availability percentage. So what we can do is, again, check these specific reasons. Two of the most common ones are going to be curtailment, which is often allowed based on economic conditions, usually if prices were negative, or if the system operator directed that notice. So we can check against if they gave you a heads up. A lot of these system operator notices, they do give you a notice at the time of the curtailment incident that it's going to happen. And then there's also weather. So this is where, like Winter Storm Fern, I think many developers issued a force majeure, and we can verify the weather conditions at the site, seeing if it actually had a big impact from low temperatures, icing, and so on.
All right, that was a lot between the four pillars. Thank you for bearing with us. Great to see that we have the same number of people on the line as we started with. So y'all are energy wonks just like us. Nice. So let's think about this. Like that's a lot of information. Your management, your finance team, your counterparties don't want all of that every month on every asset, right? So I think the big takeaways here from this conversation are, let's explain the data in a structural way to provide clarity. So we're not just giving raw data. Wind speeds were 3.6 meters per second. Doesn't mean anything. How is that relative to what we expected or relative to past performance? I can't underscore enough the power of telemetry. So let's think about having near real-time access to this information as opposed to a 25 45-day lag if you're talking the beginning of 1 month through the third week of the following. Applying this four-pillar framework to just say the impact, these are the different impacts that we can quantify as a variation from either our expected result or last year's result. And then trust but verify. It's great that in your contract, the developers are obligated to provide you with information, and most of the time they do a really great job of that. But this is a financial settlement. This is a contract, and your EPS is on the line. So let's think about taking those reports, or before we even get those reports, having a good understanding of where we are month to date, year to date, contract term to date, for all those different terms that Amber was discussing. So that when you get the report, you know what to expect. And if there are deviations, you have real data to say, hey, I think that let's have a constructive conversation about these deviations and make sure that we're all aligned on the what's happening. All right, we got through everything. That was dense, but really, I think just in our experience working with tens of clients here, what a lot of our clients are valuing on a month over month basis, quarter over quarter basis, is just having that proactive understanding of what's happening with their resources rather than reacting after a problem is identified retroactively. And this four-pillar framework really gives you the tools to do that. Blake, I'm going to invite you back. I think we saved 5 or so minutes for some Q&A. Let me know. Were people active? Do we have some questions here?
Yeah, we got a few questions. Great job, guys. We'll try to get to as many as we can. But first one coming at you. So, when a developer points to weather as the reason for their underperformance, how do you determine whether it's truly force majeure versus something operational?
So we're working in reverse order here. That's probably the most recent question in the Q&A based on our order. Yeah, let's think through this. So, okay, force majeure notice issued. Winter Storm Fern, very, again, timely, relevant. Didn't plan it. It wasn't, the webinar was on the calendar first, I promise. So the kind of maybe a three-check system here is maybe I'll add a fourth or go down to two, but we're flying by the seat of our pants. I would first look at the resource availability. So was it actually constrained? What were the wind speeds? Were they too fast for the turbine operation? What were the temperatures? Was it too cold to run the turbine? Was there precipitation that could have caused icing? What were humidity levels? These are all data that we have and we can check. So I think then is looking at, the asset, was it technically available or when the resource was present or not? So this is getting into that why telemetry matters, right? So if the wind speeds were in the operating range, but the turbines were offline, that's a question on availability, but not on the weather. So we've already verified the weather. Let's then look at availability. And I think the third piece is where Amber just jumped into in detail, which is what does the contract allow? So in some cases, there may not need to even be a force majeure declared for them to pause operations, or to curtail. But in many cases, that force majeure notice is absolutely required. So let's verify. Let's look at the physical, conditions and compare them to the contract language. I hope that answers the question. It's kind of like, was it unavoidable or was it avoidable? Was it a act of nature or an act of operator? I'm going back to that tagline. I came up with it myself. Um, yeah, I think Amber, anything to add? I think that might maybe covers
Yeah,
it.
I think that covers it.
Okay. All right, next one up here with a few minutes left. How close are your real-time revenue estimates to final settlement, and where do you typically see the biggest deltas, and where do they come from?
That's going to
Yeah.
go into the telemetry question, I'm assuming. Or how accurate is telemetry data, if I can rephrase? Is that where you're getting? Maybe
Yeah.
read it again, Blake.
How
Sorry.
close are your yeah? How close are your real-time revenue estimates to final settlement?
Okay. Yeah.
Yeah, I'm happy to take this one since my team has been working a lot with the developers and seeing the actual data formats that we connect to and getting everything into a way that we can automate the process smoothly. Um, Hypothetically, the real-time telemetry data should match your invoices 100%. We should be getting exactly the data that is then used to calculate the revenue, the generation to the revenue in your invoices. There are sometimes slight deviations. I think generally we aim for 99% accuracy, and pretty minor. They're all based on maybe there was a missing reading and something that was cleaned later on in the process. Sometimes there's different ways that they count the draw of energy from the turbine or inverter themselves. So sometimes you might see negative generation. So really minor refinements that are usually made between the revenue meter reading and the invoices. And if there are any major discrepancies, we'll go to the developer and figure them out and avoid them in the future.
I would say the one thing to add there is, basis differentials are a lot of the time selected by the developer. So, there, Amber mentioned, can have sometimes tens of thousands of dollars of net spend impact. While we can identify eligible intervals, we can't get inside the developer's mind and know which ones they're going to select. So we can give you a range saying, hey, if they select all of the intervals, the max impact could be X. But we don't have, we have telemetry, not telepathy here. So, uh, nice. That was a good one. Sorry.
Good call out, Sam.
Am I the only one that cracks myself up? All right, with that, do we have any more questions, or is that the mic drop moment?
Yeah, I'll see if we can sneak one more in here. I know you just spoke to this, but I think this is a good wrap-up question as we close today. So, how do you turn all of this analysis into something concise that leadership can quickly understand without overwhelming them?
Yeah. Short answer, one slide. Done. No, just kidding. We'll go a little bit more into detail, but I do think that's like, look, we broke down these four pillars. We didn't show you an example of our output. So if you're curious, scan the code, get in touch. But we do summarize the asset performance on a single slide. So I think that what it does is allows you to lead with the answer. Start with that, right? Okay, so we were X dollars above budget. This was due to pricing despite weaker wind. One sentence, right? And then you have supporting data on the slide that tells you exactly why, despite weaker wind, the outcome was, preferred. So this is all part of taking the four pillar approach and creating this, I guess, internal scaffolding, if you will, of like, this is how we're going to report the performance of our assets on a monthly basis. You, executive finance team, whomever your audience is, know what to expect on a month over month basis from us because we have a system in place, and that standardized format just allows for clear communication, clear expectations. So I think that's the best outcome here. Executives are going to stop asking what happened and start thinking about like, what do we do next? Because you've explained what happened. So that's when you know a narrative is working and is strong. So yeah, we are at time. Look at that. I don't know if there are any more questions, but I'm gonna call it a day here. Um, get lunch here on Mountain Time. But thank you all for joining us. Please do reach out if you have any. If we didn't get to your questions, if you want to check out, how all of this lives in our software platform, we'd love to have that conversation. Amber, thank you for joining the webinar series. We're gonna have to have you back. You were great. And yeah, Blake, as always, thanks for getting the word out there. Thank you all
Thank
and
you
have a
all.
great day.
Thanks, everyone.